Welcome to the Retirement Wealth Podcast, where we help you make the most of your retirement planning journey. I'm so glad you're joining us today.
Thanks for being here. Today, we're diving into a really important topic: how to avoid those pesky required minimum distribution taxes. You know, those RMDs that can catch people off guard.
Yeah, exactly. It's something that many folks don't think about until it's almost too late. We'll cover some strategies on how to manage your distributions effectively.
Right, and we'll also talk about the importance of planning ahead. Like what steps you can take now to minimize those tax implications later on.
And let's not forget about the options available for managing your retirement accounts. It's all about making your money work for you in retirement, right?
Absolutely. We'll get into some specific examples too to really illustrate these points.
So whether you're already retired or gearing up to make that leap, this episode is packed with insights to help you navigate RMDs and keep more of your hard-earned money.
Sounds good. Let's jump right in.
Yes, let's do it. So, David, can you start by explaining what exactly RMDs are and why they matter for retirees?
You know, Emily, with all the changes happening in the economy right now, understanding required minimum distributions, or RMDs, is more crucial than ever. People are really feeling the pinch, and it's important to stay informed.
Absolutely, David. I mean, with inflation being what it is, those dollars in retirement accounts don't stretch as far as they used to. It's like you need a game plan to make sure your money lasts.
Exactly. And when RMDs kick in at age 73, it can lead to unexpected tax burdens. I've seen retirees who thought they were in a comfortable tax bracket suddenly face a higher tax rate just because they didn't plan for those distributions.
Right, and that can really mess with their overall retirement budget. I remember talking to a couple, let's call them Jim and Lisa. They thought they were set for a nice, relaxing retirement, but then they realized their RMDs were pushing their income into a higher tax bracket. It was a real wake-up call.
That's a common scenario. Many folks underestimate the impact of taxes on their retirement income. And with market volatility, their investment returns might not be as predictable as they hoped. You know, when the market dips, it can really affect their withdrawal strategy.
For sure. I mean, if they're relying on those accounts for income and the market takes a downturn, it's like a double whammy, right? They have to withdraw more just to maintain their lifestyle, which could lead to depleting their savings much faster.
Exactly. And that's why tax efficiency is so important. If they can find ways to reduce their taxable income, it can really make a difference. For instance, some retirees might benefit from converting traditional IRAs to Roth IRAs before RMDs kick in.
Oh, that's a great strategy. It's like paying taxes now instead of later, when they might be in a higher bracket. And with all the changes with Social Security, it's essential to consider how those benefits fit into the overall picture.
Right, especially with the adjustments to Social Security that are being discussed. It's becoming increasingly important for retirees to be proactive about their income streams. They can't just rely on Social Security alone anymore.
And healthcare costs are another big factor. I mean, they keep rising. A retiree's healthcare expenses can easily outpace inflation, which is a scary thought. Planning for those costs should definitely be part of this conversation.
Absolutely. I've had clients, let's say Mary and Tom, who didn't account for rising healthcare costs in their retirement planning. They ended up stretching their budgets thin because they weren't prepared for those out-of-pocket expenses.
That's such a good example. It really highlights how important it is to consider all aspects of retirement. And then there's the emotional side of this whole financial security thing. People want to enjoy their retirement, not constantly worry about money.
Yes, and that emotional stress can really take a toll. I've seen it firsthand where clients are anxious about their financial situation. They want to travel, spend time with family, or pursue hobbies, but they feel shackled by their finances.
It's heartbreaking, but it doesn't have to be that way. By taking the time to strategize about RMDs, they can create a more secure financial future. It's all about being proactive, right?
Exactly. And with the current economic trends, it's vital for retirees to be adaptable. The landscape is changing, and those who plan ahead can better navigate the uncertainties.
So, in essence, understanding RMDs and how they affect your overall financial picture is key to maintaining that peace of mind in retirement.
That's a perfect segue. into some core strategies we can discuss. There are definitely ways to manage those distributions effectively, ensuring that retirees not only comply with the rules, but also minimize their tax burden and maximize their income potential.
Yeah, I'm excited to dive into those. It sounds like there are some solid strategies out there that can really help retirees feel more secure and in control of their finances.
So, Emily, when we talk about avoiding those pesky required minimum distribution taxes, one of the first things that comes to mind is understanding the accounts you have, right?
Absolutely. It's crucial to know which accounts are subject to RMDs and which ones aren't. For example, traditional IRAs and 401ks require you to take RMDs starting at age 73, while Roth IRAs don't have that requirement during your lifetime.
Exactly. And that's a big reason why a lot of folks consider converting their traditional IRAs to Roth IRAs. The taxes are paid up front, but once the conversion is complete, any growth in that Roth account is tax-free, and you're not forced to take distributions.
Right, and it's a great strategy for those who can afford to pay the taxes now instead of later. Plus, it can help reduce your taxable income during retirement, giving you more flexibility with your withdrawals.
Speaking of withdrawals, let's dive into some effective withdrawal strategies. The 4% rule is one of the most popular guidelines, right? It suggests that if you withdraw 4% of your retirement savings annually, you should be able to sustain your portfolio for about 30 years.
Yeah, but it's not a one-size-fits-all solution. Market conditions and personal expenses really play a role. Some people might find that they need to adjust that percentage based on their lifestyle or health needs.
Good point. This is where diversification becomes essential. You want to have a mix of assets, stocks, bonds, maybe even some real estate to help balance those out. A common rule of thumb is the 70-30th portfolio, where you might allocate 70% to stocks and 30% to bonds.
That sounds reasonable. The idea is to have enough growth potential while also cushioning against market volatility, right?
Exactly. And, when you think about tax-advantaged accounts, it's also smart to consider when and how you're going to withdraw from each type. For example, you might want to withdraw from taxable accounts first, to let your tax-advantaged accounts continue to grow.
That makes sense. So if someone has, say, a mix of taxable brokerage accounts and traditional IRAs, they'd take money from the brokerage account first, right?
Right. And then, after that, they could consider withdrawing from their traditional IRA, which would help delay those RMDs for as long as possible. It's all about timing and strategy.
And what about Social Security? I've heard that your timing for that can also impact your overall tax situation.
Absolutely. The age at which you start taking Social Security can significantly affect your taxes. Waiting until your full retirement age, or even until age 70, can increase your monthly benefit, which, in turn, gives you more breathing room when it comes to withdrawals from your retirement accounts.
So if you wait longer, you'll have a higher base income, which could allow you to withdraw less from your retirement accounts, potentially reducing your taxable income.
Exactly. And that's where the bucket strategy can come into play. By segmenting your assets into different buckets based on when you'll need them, you can create a plan that minimizes taxes over the long haul.
Can you give an example of how the bucket strategy works?
Sure. You might have one bucket for short-term needs, like cash or cash equivalents that you can use in the first few years of retirement. Then you'd have a second bucket for medium-term needs, which could include bonds or other income-generating investments. Finally, a long-term bucket could be stocks or real estate, which you won't touch for at least a decade.
That sounds like a smart way to manage both your investments and your tax situation simultaneously.
Right, and it's important to regularly review and adjust those buckets as market conditions change or as your needs evolve.
And let's not forget about tax savings techniques. For example, if you're still working and contributing to a 401k, you can potentially reduce your taxable income now, which can help you in the long run.
Exactly. And if you have the option to contribute to a Roth 401k, that can be a game changer too. You're paying taxes on your contributions now, but those withdrawals in retirement are tax-free, just like a Roth IRA.
So really, it's about having that mix of accounts and knowing when to tap into them. But it can get a bit tricky. especially if you're not keeping track of all the rules and regulations.
True, and that's why working with a financial advisor can really help. They can help you navigate these strategies and make sure you're on track to meet your goals.
And it's not just about the numbers. It's also about peace of mind, knowing that you're making informed decisions for your future.
That's key, Emily. And as we wrap up this section, it's crucial to keep in mind that there are common pitfalls people can fall into when planning for RMDs and tax strategies.
Yeah, like not planning for RMDs early enough or underestimating their impact on taxes.
Exactly. Or sometimes people rely too heavily on a single strategy without considering how it fits into their overall financial picture.
It's important to be proactive, not reactive, right?
Absolutely. Being informed and having a plan can really make a difference.
So, listeners, keep these strategies in mind as you plan for your retirement. They can help you avoid unnecessary taxes and make the most of your savings.
And as we transition into discussing those common pitfalls, it's a great reminder that retirement planning is an ongoing process, not a one-time event.
Let's dive into that next.
You know, Emily, one of the biggest pitfalls I see with retirees is ignoring the impact of taxes on their withdrawals. A lot of folks think, I'll just take out what I need, without really considering how those withdrawals can push them into a higher tax bracket.
Right, and that can really eat into their retirement income, can it? I mean, if you're not careful, you could end up paying way more in taxes than you anticipated.
Exactly. I had a client last year, let's call him Tom. He was withdrawing funds from his IRA without thinking about the tax implications, and by the end of the year, he was shocked to find out he owed a significant amount in taxes. It really cut into his budget for the following year.
Wow, that's a tough lesson. Did he have a plan in place originally?
Not really. He thought he could just wing it, but what he didn't realize was that those withdrawals not only affected his tax bill, but also his Medicare premiums. So it became a double whammy for him.
That's a great point. Medicare premiums can increase based on income, right?
Absolutely. It's called IRMAA, Income-Related Monthly Adjustment Amount. If your income is above certain thresholds, you get hit with higher premiums. So in planning, you really have to look at your entire financial picture and not just focus on immediate needs.
What other common mistakes do you see people making as they navigate their retirement planning?
Another big one is underestimating healthcare costs. A lot of retirees think, oh, I'll be fine, I have Medicare. But Medicare doesn't cover everything, and out-of-pocket expenses can pile up quickly.
Totally. I've read that many people underestimate their healthcare expenses by tens of thousands of dollars.
Right, and there was a couple I worked with, let's call them Sarah and Mike. They had a decent nest egg, but didn't account for healthcare costs. They thought they'd spend around $200 a month on premiums, but once they factored in copays, medications, and long-term care, they realized they needed to set aside a lot more.
That must have been a wake-up call for them.
It really was. They had to adjust their budget and make some tough decisions about their travel plans and lifestyle. If they had planned more thoroughly for those potential healthcare costs, they could have avoided that scramble.
So what do you suggest for someone who might be in a similar situation? How can they spot those red flags early on?
Well, first, I recommend that people have a comprehensive financial plan that includes detailed projections for healthcare costs. They should also consider long-term care insurance or other strategies to mitigate those expenses.
Makes sense. And what about the sequence of returns risk? That's something I hear about often, but it can feel a bit abstract.
Yeah, sequence of returns risk is crucial. It refers to the order in which your investment returns occur. If you have a market downturn early in retirement and you're withdrawing money from your portfolio, it can significantly impact your long-term financial health.
Can you give an example of how that plays out?
Sure. Let's take a hypothetical retiree, Jane. If Jane retired in 2008, right when the market was crashing, and started taking her withdrawals, she was forced to sell assets at a loss. If she had retired just a couple of years earlier, she would have been in a much better position.
That's a tough spot to be in. So how can retirees protect themselves against that risk?
Diversifying their portfolio is key, but also having a strategy for withdrawals. One approach could be a bucket strategy, where you have different buckets of money for short-term and long-term needs.
That sounds like a smart way to manage that risk. What about Social Security? I've heard that claiming it too early can be another mistake.
Yes, that's a common pitfall too. Claiming Social Security at 62 might sound tempting, but it can drastically reduce your benefits for life. I had a client named Jim who claimed early because he wanted the money right away, but he didn't factor in the long-term implications.
What happened with Jim?
Well, he ended up losing a significant amount over his lifetime. If he had waited even a few years, he could have received a much larger monthly benefit.
So it's really about finding that balance, isn't it?
Exactly. It's about understanding your needs, your health, and your longevity. There's no one-size-fits-all answer, and each person's situation is unique.
And I suppose that's where working with a financial advisor can really help, right?
Definitely. An advisor can help navigate these complexities and develop a customized plan that addresses all these factors, from taxes to healthcare to investment strategies.
So as we wrap up this section, what are some actionable steps that retirees can take to avoid these pitfalls?
First, create a comprehensive financial plan that includes a withdrawal strategy. Second, regularly review and adjust that plan as needed. Third, make sure to account for healthcare costs and potential long-term care needs. And finally, consider working with a financial advisor who can help you stay on track.
Great advice, David. It sounds like being proactive is key to a successful retirement.
Absolutely. The earlier you can spot these potential issues, the better equipped you'll be to handle them, and that can make a world of difference in your retirement years.
So where do we go from here? What's the next step for someone listening who might be feeling a bit overwhelmed?
The next step is to take a hard look at your current situation. Start by gathering all your financial documents, assess your income sources, and identify any areas where you might be at risk. From there, you can create a plan or reach out for help to ensure you're on the right path.
That sounds like a solid plan. Thank you, David, for shedding light on these common pitfalls and how to navigate them.
My pleasure, Emily. It's all about empowering listeners to take control of their financial future.
Absolutely. And that leads us to our next topic.
All right, so let's dive into some actionable steps, Emily, because, when it comes to navigating these required minimum distributions, or RMDs, having a plan is key.
Absolutely, David. I think the first thing listeners can do is to take a good look at their current retirement accounts.
Right. Take a moment to check which accounts are subject to RMDs, like traditional IRAs, 401ks, and other qualified plans. Knowing what you have will help shape your strategy.
And if you haven't already, it might be time to set up an online account with your financial institution. Places like Vanguard, Fidelity, or Schwab. They have great retirement calculators that can really help you understand your situation.
Good point. Those calculators can project your future distributions based on various scenarios. It's a great way to visualize how RMDs will affect your withdrawals and taxes.
Exactly. And while we're talking about tools, don't forget about the Social Security Administration's website, ssa.gov. It has a ton of resources that can help you plan how Social Security benefits fit into your overall retirement strategy.
Yes, incorporating Social Security into your plan is crucial. And let's not overlook tax software either. Programs like TurboTax or H&R Block can guide you through any tax implications of your RMDs.
That's a great tip. And for those who prefer a more hands-on approach, there are also financial planning apps out there, like Personal Capital or Mint. They help track your expenses and investments, which is super useful for retirement planning.
Definitely. And speaking of tracking, I recommend that listeners start a habit of reviewing their portfolio at least quarterly.
Yeah, that's a smart move. It keeps you in tune with your investments and can help you make adjustments if needed, especially as you approach those RMD ages.
Also, running retirement projections regularly is a good practice. It can highlight any gaps in your plan or even areas where you might be overestimating your needs.
Right. And it's important to remember that it's never too late to improve your plan, even if you're already retired.
Exactly. You can always make adjustments. Maybe even consider consulting a financial advisor for a more tailored approach, especially if your situation is complex.
That's a great suggestion. And for those who enjoy reading or listening, there are some wonderful books and podcasts available on retirement planning.
Absolutely. The Boglehead's Guide to Retirement Planning is a classic. And for podcasts, the Retirement Answer Man has some great insights into retirement strategies.
Those are both fantastic resources. It's all about finding what works for you and staying informed.
And building those habits, right? Setting small goals can make a big difference over time, even if it's just dedicating an hour a month to revisit your retirement plan.
Yes, it's all about incremental progress. You might be surprised how much clarity that hour can bring and how it keeps you engaged with your financial future.
And remember, it's your retirement. So take charge and make it what you want. There are always ways to optimize your strategy.
Well said, David. So, listeners, with these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today.
Well, Emily, as we wrap up, it's been a really enlightening discussion on how to avoid those pesky required minimum distribution taxes.
Absolutely, David. I think one of the key takeaways is understanding that RMDs can really impact your tax situation, right?
Exactly. And planning ahead is crucial, like considering your withdrawal strategy. It's not just about taking the minimum, but optimizing how much you pull out to minimize taxes.
Yeah, and that ties into the second point about tax diversification. Having a mix of tax-deferred, tax-free, and taxable accounts can really give you flexibility in retirement.
Right, and let's not forget about the importance of staying informed about tax law changes. They can happen, and you want to be prepared,
For sure. And finally, we talked about working with a financial advisor. It can make a huge difference in navigating these waters effectively.
Definitely. Having that guidance can really help you build and protect your retirement wealth so you can enjoy your golden years without the stress of taxes looming over you.
It's all about making informed choices, right? And we hope our listeners feel empowered to take those steps.
And if you found today's conversation helpful, please take a moment to like, subscribe, and comment. We'd love to hear your biggest takeaway or any questions you might have.
Yeah, and if you know someone who's planning for or already in retirement, share this episode with them. It could really help them out.
And next time, we'll dive into the pros and cons of owning rental property in retirement. It's a topic that brings up a lot of interesting perspectives.
Can't wait for that discussion.
Thanks for joining us today.
Take care, everyone.